Hello everyone and welcome! In today's video, we're diving deep into how to effectively manage your finances. Specifically, if you're earning $5,000 a month in the United States and have recurring expenses totaling $2,900. That's $2,500 for rent and $400 for food and utilities. This leaves us with a significant opportunity for savings, and more importantly, for making that money work for us through strategic investments. It's fantastic that you're looking to take control of your financial future. Understanding your income and expenses is the crucial first step. With a clear picture of your monthly cash flow, we can now create a robust plan to not only save diligently, but also explore avenues to grow your wealth over time. Remember, building financial security isn't just about earning, it's equally about managing, saving, and strategically investing your hard-earned money. This plan will walk you through a step-by-step approach, starting with a detailed breakdown of your current financial situation, then outlining a structured savings strategy, and finally, introducing various investment options tailored to different risk tolerances and financial goals. We'll also touch upon the importance of setting clear financial goals and regularly reviewing your plan. Let's get started on this journey towards financial empowerment. As you've already identified, your monthly income is $5,000. Your essential monthly expenses are rent, $2,500, food and utilities, $400. This brings your total mandatory monthly expenses to $2,900. Therefore, your potential monthly savings are monthly savings equals monthly income minus total monthly expenses. Monthly savings equals $5,000 minus $2,900, which equals $2,100. This $2,100 represents a significant portion of your income that can be strategically allocated towards savings and investments. This is a strong starting point, and consistently saving this amount can lead to substantial financial growth over time. Before we jump into specific investment strategies, it's crucial to define your financial goals. These goals will act as your roadmap and will influence the types of investments you choose. Consider both short-term and long-term objectives. Short-term goals, spanning 1 to 5 years, might include building an emergency fund, ideally covering 3 to 6 months of living expenses. You could also be saving for a down payment on a car, a smaller purchase, or perhaps funding a short-term educational course. Medium-term goals, which cover 5 to 10 years, could involve saving for a down payment on a house, funding a significant life event like a wedding, or planning for a career transition. Long-term goals, those extending 10 years or more, typically include retirement planning, saving for your children's education, or building long-term wealth. Having these goals clearly defined will help you prioritize your savings and choose investments that align with your time horizon and risk tolerance. For instance, money needed for a down payment in 2 years will likely be invested more conservatively than funds intended for retirement in 30 years. The first and most crucial step in any savings plan is to establish an emergency fund. This fund acts as a financial safety net for unexpected expenses, such as medical bills, job loss, or unforeseen home or car repairs. A general rule of thumb is to aim for 3 to 6 months of essential living expenses in your emergency fund. Based on your $2,900 monthly expenses, this means you should aim to save between 3 months, $2,900 times 3 equals $8,700. 6 months, $2,900 times 6 equals $17,400. Initially, focus a significant portion of your $2,100 monthly savings towards building this emergency fund. Once you reach your target, for example, $10,000 or $15,000 as an initial comfortable buffer, you can then allocate more funds towards investments. Keep your emergency fund in a safe, easily accessible, and liquid account, such as a high-yield savings account. While the interest earned might be modest, the peace of mind and financial security this fund provides are invaluable. Now that you understand your savings potential and the importance of an emergency fund, let's outline a monthly savings strategy. With $2,100 available for savings and investment, consider the following allocation once your emergency fund is adequately funded. Dedicated savings account. Allocate a specific amount each month, for example, $500 to $1,000 initially, increasing as your emergency fund grows, to a separate high-yield savings account for your medium-term goals or for further investment capital. Automate this transfer each month to ensure consistency. Investment allocation. The remaining portion of your monthly savings, for example, $1,100 to $1,600 initially, can be directed towards various investment vehicles based on your risk tolerance and financial goals. This is where your savings can start to grow more significantly over time. Here are several investment options to consider, ranging from lower to higher risk, high-yield savings accounts, which are low risk. While primarily for your emergency fund, you can continue to utilize these accounts for short-term savings goals, benefiting from slightly higher interest rates than traditional savings accounts. Certificates of deposit, or CDs, offer a fixed interest rate for a specific period. They are relatively low risk, but your money is locked in for the term. Consider laddering CDs with different maturity dates to provide more flexibility. Money market accounts are similar to savings accounts, but may offer slightly higher interest rates and sometimes check-writing capabilities. They are generally low risk and liquid. Index funds and ETFs, or exchange-traded funds, are baskets of stocks or bonds that track a specific market index, such as the S&P 500. They offer diversification, which helps to reduce risk compared to investing in individual stocks. ETFs trade like stocks on an exchange, offering liquidity. Index funds are typically bought through a brokerage account. Individual stocks, which come with higher risk, involve investing in individual company stocks. This can offer potentially higher returns, but also comes with significantly higher risk. Thorough research and understanding of the companies are crucial. Generally, it's recommended to allocate a smaller portion of your portfolio to individual stocks, especially when starting out. Bonds, which carry low to medium risk, represent debt issued by corporations or governments. They typically offer lower returns than stocks, but are generally less volatile. You might want to consider government bonds, corporate bonds, or bond ETFs. Real estate, which varies in risk, can be a long-term wealth-building strategy. This could involve purchasing rental properties or investing in real estate investment trusts, or REITs, which are companies that own and operate income-producing real estate. Retirement accounts, tax advantage. Take advantage of tax-advantaged retirement accounts available in the U.S., such as 401(k). If your employer offers a 401(k) plan, especially with an employer match, contribute at least up to the match to receive free money. Roth IRA and traditional IRA. These are individual retirement accounts that offer different tax benefits. Research which one best suits your financial situation. The contribution limits for 2024 are $7,000, with an additional $1,000 catch-up contribution for those age 50 and over. Important considerations for investing. Risk tolerance. Understand your comfort level with potential investment losses. Younger individuals with a longer time horizon typically have a higher risk tolerance. Time horizon. The length of time you plan to invest your money will influence your investment choices. Longer time horizons allow for potentially riskier investments with higher growth potential. Diversification. Spread your investments across different asset classes, such as stocks, bonds, and real estate, and within each asset class, for example, different sectors of the stock market, to reduce risk. Dollar cost averaging. Consider investing a fixed amount of money at regular intervals, like monthly, rather than trying to time the market. This strategy can help to reduce the risk of buying high. Seek professional advice. If you feel overwhelmed or unsure, consider consulting with a qualified financial advisor who can provide personalized guidance based on your specific situation and goals. Your financial plan is not static. It's essential to review your budget, savings, and investments regularly, at least annually, or more frequently if there are significant changes in your income or expenses. This will allow you to make necessary adjustments to stay on track to achieve your financial goals. Managing your finances effectively and strategically. Investing your savings is a journey, not a destination. By understanding your cash flow, setting clear goals, building a solid emergency fund, implementing a consistent savings plan, and exploring suitable investment opportunities, you can significantly enhance your financial well-being and work towards a secure financial future. Remember to stay informed, be patient, and adapt your plan as your circumstances evolve. Thank you for watching, and I hope this detailed plan helps you on your financial journey.